In this module, we will look at 4 fundamental principles of finance that we need to keep in mind throughout the rest of the subject. In previous modules, we talked about finance as being a tool to help us make decisions. We make decisions by weighing up the costs and benefits of that decision. And if the value of the benefits exceeds the value of the costs, we should go ahead with that decision. If the benefits and costs can be quantified using dollar values, then this is called financial decision making. In order to make any financial decision, we must be able to determine the value of the benefits and costs. Notice here that we make repeated use of the word value. In this module, we will look at exactly what we mean by value. How exactly do we measure the value of something, such as a share? The answer is that the value of any asset is the present value, or the value today, of all future cash flows. After all, those cash flows are what gives the asset value in financial terms. So the value of the cash flows determines the value of the asset. Notice the term present value. We will touch on what that means in this module, but we will go into it in much more detail in the next topic. Determining the value of future cash flows isn't always a simple task. It is not a matter of simply adding up the dollar values. There are 3 factors, which I call critical factors, that we must take into account in determining value. They are cash, time, and risk. The reason that cash is a critical factor is that only cash has value. Only cash can be used to buy things, to pay a firm's expenses, to pay dividends to shareholders, and ultimately to achieve the goal of corporate finance, to increase the wealth of shareholders. We can highlight the importance of cash by comparing it with a similar but different concept: accounting profit. Accounting profit is the difference between revenue and expenses over a specified time period, and therefore is designed to measure the performance of the firm over that period. However, accounting profit is not the same as cash. Accounting profit doesn't give value to the firm, only cash does. Generally, there is a correlation between accounting profit and cash, but not necessarily. There are fundamental differences between profit and cash. For example, profit includes non-cash book entries, such as accruals and depreciation. Accruals means recognizing revenue or expenses where the cash flow has not actually occurred, in order to try and match revenue and expenses within the specified time period. But they are not cash flows. You can't buy anything with accrued revenue because it's just a book entry. No cash has changed hands. Depreciation is also designed to match revenue with expenses and is treated as an expense in accounting, but it is not a cash flow. Just because you've included depreciation in your calculation of profit doesn't mean any cash has changed hands. The cash changed hands when you bought the asset being depreciated, probably years earlier. Another problem with accounting profit is that it is subject to inconsistency between firms and possibly deliberate manipulation. This is much less likely with cash, and it is therefore a more reliable indicator of value. The reason time is important is because the value of a cash flow is affected by the time period when it occurs. The further into the future a cash flow occurs, the less valuable it is today. We need to take account of time whenever we calculate the value of a cash flow. Again, we can make a comparison between cash and accounting profit. The calculation of profit treats all dollars as being of equal value no matter when they are received. In other words, accounting profit does not make allowance for the time value of money. We will deal with this concept in much more detail in the next topic, but we will continue to refer to it throughout the rest of the subject. Risk is a critical factor because the future is uncertain. When we determine value based on future cash flows, we need to take into account the possibility that the cash flow will be different from what we expect or may not occur at all. The uncertainty or risk of a cash flow affects its value, and we often need to make an adjustment to the value of a cash flow because of risk. Once more, we can contrast this with accounting profit. Accounting profit treats all dollars as if they will occur with certainty, and therefore makes no allowance for risk. It is not my purpose to be critical of accounting profit. It has a function, it's just a different function from financial decision making.